Let's be real, most people jump into investing without a clue about how the game is played. They chase the next big thing, hoping to get rich quick. But here's the truth. Investing is not a get-rich-quick scheme. It's about understanding that every investment carries risk. The higher the potential reward, the higher the risk you're taking on. Think of it like climbing a mountain. The higher you climb, the more breathtaking the view, but also the steeper the drop if you're not careful. Before you even think about buying a stock, bond, or that trendy cryptocurrency everyone's talking about, you need to understand what you're getting yourself into. What's the worst-case scenario? Can you afford to lose the money you're putting in? Don't just focus on the potential gains, understand the potential downsides too. Knowledge is power, especially in the investing world. Take the time to learn the basics of different asset classes, stocks, bonds, real estate, you name it. Understand how they work, their historical performance, and the risks associated with each. Don't be afraid to start small. You don't need a fortune to begin investing. What's more important is developing a solid understanding of the fundamentals. Remember, slow and steady wins the race. Don't rush into anything until you feel confident about your knowledge and risk tolerance. Develop your own investment strategy based on your individual circumstances. Figure out your financial goals, your time horizon, and how much risk you're comfortable taking. Think about it. Nature is the ultimate diversifier. A forest isn't just one type of tree, it's a thriving ecosystem of diverse flora and fauna, each playing a crucial role in the ecosystem's overall health. Your investment portfolio should be no different. Putting all your money into one stock, no matter how promising it seems, is incredibly risky. It's like putting all your eggs in one basket. If that basket falls, you lose everything. Diversification is about spreading your risk across different asset classes, stocks, bonds, real estate, maybe even a little bit of gold. This way, if one investment isn't performing well, the others can help cushion the blow. But diversification goes beyond just different asset classes. Within each asset class, you want to diversify even further. Don't just invest in one or two stocks. Spread your bets across different sectors and industries. For example, don't just invest in tech companies. Consider healthcare, consumer goods, energy, and more. Think about it like this. If you invest heavily in just one industry, and that industry experiences a downturn, your entire portfolio takes a hit. But if you're diversified across multiple industries, the impact is minimized. Geographic diversification is also crucial. Don't limit yourself to just your home country. Consider investing in international markets as well. This exposes you to different economies, currencies, and growth opportunities. Remember, the global economy is interconnected, and diversifying globally can help reduce the impact of any single country's economic fluctuations on your portfolio. One of the easiest and most effective ways to diversify is through low-cost index funds and ETFs. These funds track a specific market index like the S&P 500 or the MSCI World Index, giving you instant diversification across hundreds or even thousands of stocks with a single investment. Don't be afraid to rebalance your portfolio periodically. As your investments grow at different rates, your asset allocation will drift from your original target. Rule number 3. Learn from history. Markets rise and fall. Don't panic. History has a funny way of repeating itself, especially in the financial markets. If you look at the stock market's performance over the past century, you'll see a clear pattern of ups and downs, booms and busts. But here's the thing. Despite these fluctuations, the overall trend has been consistently upward. The market moves in cycles. There will be periods of rapid growth followed by corrections or even recessions. It's important to understand that these cycles are a natural part of the market's ebb and flow. Don't let short-term fluctuations shake your long-term investment strategy. One of the biggest mistakes investors make is letting their emotions dictate their decisions. When the market is soaring, they get greedy and jump in at the top, only to lose money when the inevitable correction occurs. Conversely, when the market crashes, they panic and sell at the bottom, locking in their losses and missing out on the eventual recovery. Remember, the stock market is driven by fear and greed. When everyone is euphoric and buying, that's usually a sign that the market is overheated. Conversely, when everyone is panicking and selling, it often presents a buying opportunity for savvy investors. Instead of trying to time the market, which is incredibly difficult even for professionals, focus on time in the market. The longer you stay invested, the more time you have to ride out the market's ups and downs and benefit from the power of compounding. Think of it like planting a tree. You wouldn't dig it up every time there's a storm to see if the roots are still intact. You plant it, you nurture it, and you give it time to grow. The same principle applies to investing. One of the best ways to avoid emotional decision-making is to have a clearly defined investment plan and stick to it. Your plan should outline your financial goals, your risk tolerance, your asset allocation, and your investment strategy. Having a plan in place will help you stay disciplined when the market gets volatile. Rule number 4 / costs, fees, and taxes are silent wealth killers. You know that feeling when you get a great deal on something? It's like getting free money, right? Well, the same principle applies to investing. The less you pay in fees and taxes, the more of your hard-earned money stays in your pocket working for you. Fees might seem small and insignificant, but they can eat away at your returns over time. Think about it like this. If you're paying a 1% annual fee on your investments, that means you're losing 1% of your money every year, regardless of how the market performs. Over time, those seemingly small fees can add up to a significant amount of lost potential earnings. The same goes for taxes. Every time you sell an investment for a profit, you'll owe capital gains taxes. These taxes can take a big bite out of your returns, especially if you're trading frequently. That's why it's crucial to minimize your tax liability whenever possible. One of the easiest ways to reduce your investment fees is to opt for low-cost index funds and ETFs. These funds typically have expense ratios well below those of actively managed mutual funds, meaning you get to keep more of your money working for you. Remember, every dollar you save in fees is a dollar that can be invested and grow over time. Another way to minimize costs is to avoid unnecessary trading. Every time you buy or sell an investment, you incur transaction costs. These costs can add up quickly, especially if you're a frequent trader. Instead of trying to time the market, which is notoriously difficult, focus on buying quality investments and holding them for the long term. Rule number 5, master your mind. Greed and fear will wreck your portfolio. Investing is as much a mental game as it is a financial one. Your biggest enemy isn't the market, it's yourself. Your emotions, greed and fear, can lead you to make irrational decisions that sabotage your long-term financial well-being. Think about it. When the market is on fire and everyone's making money, it's easy to get caught up in the hype and start chasing returns. You see your friends and neighbors getting rich quick, and you don't want to miss out. This fear of missing out, or FOMO, can lead you to make impulsive investment decisions, buying high and selling low, ultimately hurting your portfolio in the long run. On the flip side, when the market crashes and everyone's panicking, it's natural to feel afraid. You see your portfolio value plummeting, and you start to doubt your investment strategy. This fear can lead you to sell your investments at the worst possible time, locking in your losses and missing out on the eventual recovery. The key to mastering your emotions is to understand that they're a natural part of the investing process. Everyone experiences greed and fear. It's what makes us human. The difference between successful investors and unsuccessful ones is how they manage those emotions. One of the best ways to control your emotions is to have a clearly defined investment plan and stick to it, no matter what the market is doing. Your plan should outline your financial goals, your risk tolerance, your asset allocation, and your investment strategy. Having a plan in place will help you stay disciplined when the market gets volatile and prevent you from making emotional decisions. Remember, investing is a marathon, not a sprint. There will be ups and downs along the way. There you have it. The 5 rules most investors ignore, often to their detriment. Remember, investing isn't about gambling or chasing the latest hot stock tip. It's about understanding the game, managing risk, and making smart, informed decisions that align with your long-term financial goals. By following these 5 rules, you're not just investing in the market. You're investing in yourself, your future, and your financial well-being. Start by educating yourself, developing a solid investment plan, and seeking professional guidance when needed. Remember, the best time to start investing was yesterday. The second best time is today. So, take control of your financial future. Start investing wisely, and watch your wealth grow over time.